November 15, 2017, 10:39 AM EST. There was much to cheer in Target Corp's third quarter earnings results. It delivered comparable sales growth for the second consecutive quarter, thanks to a healthy 1.4% increase in traffic compared to the same period last year. Signs of life. Improved traffic at Target helped the retailer notch positive comparable sales this quarter, and last source, Bloomberg. Yet investors sent the shares down, likely because they were more focused on other numbers in Thursday's report, namely, that net income fell 21% from a year earlier. And even as CEO Brian Cornell declared in a press release that his team is very confident in its holiday season plans, Target's earnings forecast for the fourth quarter wasn't as upbeat as investors had hoped. But if you take a long-term view of Target's prospects, it's hard to be overly concerned about this hit to profitability. And that's because the big box store is spending money on the right things. In part, Target's profit was crimped in the quarter because it remodeled 37 stores, a step in an ongoing effort to revamp more than 1,000 locations by 2020. For a retailer that in the latest quarter drew 96% of its sales from brick-and-mortar stores, it's hard to argue against spiffing up its fleet. Number of stores. Target spent money to remodel in 3Q37. Meanwhile, it also raised its minimum wage to $11 per hour in October. With a tighter labor market and competitors such as Walmart Stores Incorporated having long ago bumped up their wage floors, this is a smart way to attract and retain workers. Still more profit pressure came from lowering prices on everyday essentials. There were signs this helped Target in key ways in the quarter. Executives said they saw a meaningful increase in sales at regular price in the quarter, along with an increase in customers making shorter, quicker, fill-in trips. That suggests the price cuts are helping get shoppers in the door. Hear those footsteps? Target's traffic patterns have been looking better in the last 2 quarters. The increase in fill-in trips helped drive this latest improvement. Source, company filings. And finally, fulfillment costs for online orders also weighed on profitability. But that's not such a bad thing, as it's a byproduct of growing e-commerce sales. More digital shopping. Target's e-commerce sales growth has been relatively strong, outpacing the online sales growth in the wider retail industry. Source, company filings. All of this is to say that the parallel universe in which Target does not take these profit-eating steps is much worse for the company. For more information, please follow the link below the video.